All right. Well, welcome to the Foxstone Financial Wealth Matters Show. I have some special guests with me here in the studio today. Guys, thank you very much for joining me. We have a very, very interesting conversation. As you guys know, the Foxstone Financial Wealth Matters Show, what we do is bring people into the studio that may or may not have anything to do with our field of direct work, which is financial investing and wealth management, and we bring people in that have an impact on people's lives. Well, today just so happens that we are going to be talking about a field of expertise that we feel like has a very, very direct impact on people's lives, and it happens to be in the wealth management, investment management space. So, gentlemen, thank you for being here. Brian, you've been here before. Thank you for coming back.
Thank you.
And Robert, thank you very much for joining us.
Great to be here.
I'll let you guys introduce yourselves.
Robert, why don't you start?
Well, I'm Robert Blaha, and I'm the Vice Chairman of Integrity Bank and Trust. We've been around for about 17 years now. We're focused mainly in Southern Colorado, and we've seen dynamic growth like a lot of people have in Colorado. We manage several locations from a bank standpoint, and we've got a wealth management firm as well.
Perfect.
And Brian Watson, I'm the founder and CEO of North Star Commercial Partners, founded the company 20 years ago, headquartered here in Denver. We own assets in 15 states throughout the country with offices in New York as well.
Perfect. All right, so let's jump into the reason that you guys are both here, right?
Okay.
'Cause you may be thinking, people that are watching me, what? That's kind of a weird combination. Are we talking about banking or are we talking about commercial real estate? But you guys have a pretty fantastic strategy that you guys are rolling out, an investment strategy. So let's jump into what is it, and how did you guys get here, and why did you decide to, use your expertise and team up with Robert and to roll it out to the average investor?
You bet. So, as I said, I founded my commercial real estate investment company 20 years ago, and we've been doing deals for 2 decades now, and have really been trying to drive wealth for our investors. The vast majority of our investors are high net worth individuals. And Robert and I have been friends for a long time, but we've also been investment partners. In fact, he and the Integrity team have invested in 38 individual real estate transactions with us over the years. And through that time, we've been blessed and fortunate in making good returns together on those investments. And we decided to partner up. And we think it's a very unique vehicle where a trust company partners directly with a commercial real estate investment company. And there's many benefits go along with that. Robert, do you want to add to that?
Yeah. Brian and I have been friends for a long time, and we had an opportunity really to take what we had done together and find a way to extend it to a lot more people. And that really was the concept. As a wealth management firm, we've run funds before, but we decided to create this fund very unique, very different than a normal REIT. The structure's different, how it pays out is different. The upside numbers that we're talking about are quite different as well. So we're really excited about it. And as Brian said, we've done a lot of deals together. And the way it really came about is we were talking about how do we extend the model? How do we do something different? And different people either weren't interested in doing a one-off deal, or maybe they were in a U-bit, or they were someplace else and they couldn't get to a structure where they deferred and spread the cost over a number of deals. So we're providing that opportunity.
Absolutely.
So Robert, you mentioned U-bit for folks that may not catch that.
Why don't you explain it? You're
the expertise. You're the expert here. I'm just the moderator.
Yeah. There's a number of different vehicles that because you're either set up in a personal specific situation, so you can't get to an investment to do a one-off. That we wanted to provide that opportunity so you could diverse your risk over a number of different products. So we're going to have a number of different products, number of different buildings in this specific fund, which will allow people to spread that fund over a bunch of different deals.
Perfect. All right. So when people hear about this, they may generally, from a 10,000-foot view, say, well, this is just another REIT, right? There's lots of REITs to choose from. We know that that's not the case, right? And you briefly touched on it. Brian, you've been in the business for 20 years, right? So that dates back to even the pre-financial recession, right? The dot-com boom. So how is this REIT, right? How is this strategy different than your normal vanilla REITs out there that we see?
Absolutely. Well, we're definitely not a REIT. The structure is a REIT, and we did it to create flexibility for our investors so they could come in and out of the fund as they may wish to. There's also some tax and legal benefits, which we encourage them to seek good tax and legal counsel with regards to it. But we're not a REIT from the perspective of usually a REIT is a public vehicle that is usually on Wall Street or whatever it might be. And they're on this constant treadmill of trying to create cash flow. They're also very fee driven. So for instance, at North Star, we are not adding on a CEO salary and all the staff salary onto this particular vehicle. In fact, none of those costs are going to be onto this vehicle. There are fees that will come from the vehicle, the fund vehicle, that will benefit North Star, of course, as we go ahead and execute. But we're not overlading that with a ton of fees and expense that reduce the amount of money that gets back to the investors. So we're putting the investors at the front of the line with this particular structure. And we're also providing a 10% preferential return on an annualized basis. That's an extremely high hurdle rate as the first tier of distribution. In fact, it's pretty much unheard of in a lot of structures. But we're doing it because we are confident in our ability to perform. Now, past performance doesn't guarantee future success. But if you look at most of our investments, we've continuously been able to drive a high teens, mid-20s, or more return to the investor level. And frankly, this is the best investment structure that I've ever offered outside investors. Normally, my structure, we're sharing in 50% of the back-end profits. In this particular structure, investors get a 10 pref, annualized. They then get a full return of every dollar invested, so their risk and exposure is out of the transaction, out of the fund. And then they get 80% of all ongoing profits with Integrity and North Star sharing the other 20%. So investors are at the front of the line. They're put in a very flexible structure. We're not on a treadmill just trying to drive cash flow, and we're not overlaying this fund and burdening it with a tremendous amount of expenses. Robert, do you want to add to that?
Well, I think maybe the most important thing to investors is return. You know, we are anticipating someplace between 14 and 18% plus some quarterly returns. Those are stunning numbers. They really are. And so the reason we can do that is based on the past performance. What we did, we look at it a little different lens from a fiduciary standpoint, from a wealth management standpoint. So we look at it a different lens than Brian does. So we've got the two lenses put together now to actually create a very unique look for the product. We actually have done forensics on dozens and dozens of Brian's deals going back the full 20 years. And the reason we did that is we wanted to see what we really thought would be a reasonable number to put out there with people. As Brian pointed out, there's no guarantee for returns any place in the world that I know of. But at the end of the day, what do we think we can do? And the numbers that we're throwing out are actually unparalleled. It's kind of similar to what you might see in a really, really big firm. Really like a Blackstone somewhere, they go out and they buy several $1 billion worth of something. But what Brian's expertise is very unique. He's able to go in and find buildings in the 100 to 150,000 square feet to 300 to 400,000 square feet. Identify those, apply his algorithm, which he's developed over the last 20 years, and get phenomenal returns. What we're able to do is come in and add all the legal pieces of that, run the fund in a very efficient, very cost-efficient way, put those two things together, and offer a product that just isn't available.
So I want to make this clear. You've been doing this for 20 years. I mean, you've said that, right? You've been doing the same thing, providing tremendous value up to this point for all of your private investors. Folks that come in with millions of dollars and say, we want to team up with you. Here's some money. Put it to work for us.
Correct.
You're taking what you have done for the affluent, accredited investor over the last 20 years, and you're making it available to the general public, let's say. For those that qualify.
Yes. We're not only doing that, but having a fund structure allows us to, I think, get access to even better deals because we'll have the money at the ready. Traditionally, we've raised money on a deal-by-deal basis. And now by having a fund, it gives us even more negotiation leverage in a transaction because somebody can call up the bank and confirm that the check will clear. That gives us even better negotiation leverage going into transactions. We're also going to have diversification. So instead of an investor going into one deal, deal. Now they'll participate in a fund that'll give them access to multiple deals, helping to diversify their risk, is what Robert was talking to.
Yep.
And then we also now are offering a better structure than I've ever offered in the history of my company. You know, when you first start off a company and you're trying to raise money, you know, they say friends and family. Well, I didn't come from a family with money. My family taught me about blessings and hard work and said, good luck. And so I had to raise the money on an individual deal basis. And we've been blessed and fortunate to now we have, 10 of the top 100 wealthiest people in the world that invest with us, and banks and all kinds of different great groups. But in that, I've always offered a different structure, actually a structure that was more favorable to me in the back end. In this fund structure, again, I'm offering a much better overall restructure to the investors. And if you were to overlay this structure onto our historical returns and what our average returns have been for over 2 decades, it would be even more so in the investor's favor.
And that's perfect. So I'm glad to hear that, and I'm sure people are kind of licking their chops right now, like, this is unbelievable. How do I get a hold of this, right? So, and we will get to that because this is a brand new offering that is out on the market, and you guys are super, super excited about it, as are we, because if folks know anything about us, we're trying to drive additional alpha in our clients' portfolios, and we feel like this could be a way to do that. Now, here's some concerns that I hear from clients, right?
Sure.
This is just another REIT, right? So we've kind of touched on that. I kind of want to hammer that just one more time, right? And the overarching kind of caution that people are feeling is this headline risk with tweets and what's going on in the political economy. I'll say the political comma and economy. And Brian, I wanted you to kind of touch on that. In your expertise over the last 20 years, we've gone through several cycles, but how do you see commercial opportunities popping up throughout the economic cycle and or political cycle, if there's any difference there?
Absolutely. So I'll tackle that question. And Robert, if you want to tackle the question about the REIT, and we'll finish up there.
Sure.
So with regards to the economy, I have been doing deals throughout the best economies to the worst economies since the Great Depression. And what I've learned is there's always an opportunity. And I am not buying the market. What I am buying is individual deals within the market. So yes, do I believe a recession is coming? Absolutely. And in fact, I think a recession in some ways will actually be much better for us on the commercial real estate investment side, because so much money is trying to get into commercial real estate right now. It's a really good way to kind of let some of the steam off the kettle. And so as people make overgeneralizations about a market, they tend to throw the baby out with the bathwater, right?
Yep.
They say, there's going to be a recession. We're too late stage in the cycle. Real estate is concerning. And I encourage them, go ahead and say that, because when you do that, I have less competition on the field.
Right.
And so we go in and we take a rifle approach. We buy an individual asset for the right reasons and the right fundamentals. In this fund, we're trying to hit assets that have a 30% or less of their replacement cost value. I've bought assets usually at 50% or less of replacement cost value. And so having this fund right now at the ready, going into a potential recessionary environment, going into a very year where there's going to be a lot of vitriol and everything going on with the presidential election, will actually position us even better to go out and keep the lines off the back of the boat, be trolling for the right fish, and when we land the right fish, we go ahead and execute on it and drive great value. Real estate is an inherent part of most diversified, well-managed portfolios, and so we're filling that piece, and all we do is commercial real estate, and this fund is focused on the Western U.S., though we have the ability to invest throughout the country, but markets with good, positive dynamics for the future. Positive job growth, employment growth, et cetera. And so we go into those markets, we buy an asset, we start making cash flow distributions to our investors, and I think we'll be able to outperform normal market norms. And do you want to answer the question about the REIT?
Yeah. I also want to make a comment about economically. When we did the research and looked at a lot of the deals you can actually do well in a down economy.
Some of my best deals have been done in a down economy.
Which is quite different than a normal REIT. So I think a couple things really differentiate this. And most importantly is the return. This is called the opportunity fund.
Yeah.
And the reason it's an opportunity fund is because a traditional REIT, let's be blunt, traditional REIT, 6, 7, 8%, you're happy. You put your money in there. It's kind of like buying a bond, but not, because there's a little credit risk and some other things. But you're into that REIT, and you're pretty happy if you're getting that return.
Well, you're into that REIT, and I want people to understand you're into that REIT for 7 to 8 years.
Yes, yeah.
Very, very limited liquidity.
Right.
And so you're into that REIT almost like a roller coaster. Like whether it goes up or down, you're not getting out. You're strapped in, and you just hope that at the end that the ride was worth it.
Yeah.
Right?
Exactly.
And you didn't get sick.
And you didn't get sick, right? It didn't have some crazy
Wasn't one of those that went upside down.
too many times. That's exactly right. And that's a traditional REIT because, Brian, you had mentioned it earlier, right? They're just looking for cash flow.
Correct.
Yeah.
Right? They're like, oh, well, we've got apartments and we've got hospitals and we've got buildings that as long as they're 90 or 95% leased,
Well,
you should be okay.
You bring up a good point. REITs are my favorite group to actually sell to. So what we do is we usually are buying assets that, have to be improved in some way and enhance their cash flow. Most REITs go out and buy a fully leased asset or a fully stabilized asset. And I really come from this mindset that you make your money on the buy. And real estate by nature is a cost basis investment. I can't pick up a building and move it from Houston to Denver or Denver to LA. It is where it is, and I have to operate in that building in that market. And so when you set your basis so high, the way a lot of these REITs do, they don't have much flexibility.
Right.
All that they can hope and pray for is that their cash flow either A, stays the same, or hopefully goes up a little bit. But if it dips down in any significant way, that cash flow stream shuts off. So,
i.e. 2008.
yeah, exactly. And so we've bought a lot of assets that have gone completely vacant. In fact, one of the assets that Robert and I did together, a REIT owned here in Denver, was a medical asset, and their income stream left the building entirely. It went vacant. We bought this vacant medical building for less than, a quarter of its replacement cost value, and we ended up leasing it up to a medical tenant, and then we sold it, and on that particular deal, we got a 3x on our money and 101% annualized return. Now, that's a more opportunistic deal, but that's an example of our track record that we've done together over those 38 transactions, and so that's what separates us. We'll buy those buildings where we're 30% or less of replacement cost value. We'll increase that income stream. Eventually, we may sell to a REIT, but we really believe you make your money on the buy.
Well, absolutely. The point that I wanted to foot stomp there is a term a lot of people may not understand. Stabilized, a stabilized asset. What a stabilized asset is this an asset that usually is leased someplace in the 90s, certainly high 80s, 80s to 95. It's leased, it's fully. You can kind of do the math. You can kind of look at it and say, here's exactly what that cash flow looks like in the next 3 to 5 years.
Yep.
And you're locked in. Okay, there is no upside. It's stabilized.
It is what it is.
By definition.
It is what it is by definition. What Brian has been able to do is find opportunities that present themselves such that you can take and lease that building up and then sell that building to a REIT. So it's a totally different play. It's a totally different approach than a traditional REIT is. And that's why, to Brian's point, a lot of his best clients through the years have been the big REITs.
Yeah.
They come in and they swoop up a bunch of buildings. They want to sell a bunch of individuals on coming in and investing on a long-term basis. Not that that's bad. It's not bad. This just is a different product with a whole lot more upside.
And one thing I would add to that, by nature, we are real estate people at North Star Commercial Partners. Yes. First and foremost, the real estate drives the transaction. There are some financial groups out there, REITs and others, that are financial people that are saying, okay, well, we'll just put money to work and hopefully it works in real estate. Well, it all comes down to the bricks and mortar. And what does that real estate look like? What is your basis? How can you execute on it? And making sure you create an accretive model that's beneficial to your investors so you have long-time repeat investors.
So Brian's people are real estate people.
Yep.
Our people are bankers and trust officers. So the combination of the two is really quite unique. As I said, lenses. So we've got our own algorithms, and we look at things through ours. Brian looks at his through his. The combination of those two things I said earlier is very unique. So from my viewpoint, we've got a unique product at a unique time that provides a significant higher upside for clients that choose to participate. So we're thrilled about the opportunity, excited about getting going.
And one point on that is our investment committee is made up of two individuals from the trust side, Robert and a gentleman by the name of Eric Davis. And on the North Star side, two people from the North side, myself and my chief investment officer. So you have these four people on the investment committee looking at every single transaction, looking at from the banker side and that lens and the trust company side, looking at from the North Star side and the experience we have for 20 years and deciding, okay, is that a deal we should do or is that a deal we shouldn't do and why? And so it's a really methodical process versus just slapping money up against the wall hoping that it'll stick. This is always keeping the investors at the front of the line.
So, Robert, we were discussing the economy, where it's at right now, and how commercial property fits into an economic and political cycle. So I know we touched on it briefly, but I wanted to get back to what you were talking about because we kind of went on a little bit of a tangent there. How do you see
that would
this?
That would be typical.
Well, that's totally fine. That's the point of this show. You just kind of go where it goes.
That would be typical.
But I want to know, from your standpoint, obviously, trust company, bank, where do you see us in this? I mean, I don't care.
In the cycle?
I don't really care if we're late stage, early stage, but how you see commercial property in an economic cycle and how it can help to potentially diversify a portfolio. Sure. That's what I would like to get your viewpoint on.
Let me answer that in two parts. First, where do I see us in the cycle, and then secondly, what does that say about buying opportunistic deals? I think, like everybody else, I have my own crystal ball and look into it. I think we're getting long in the cycle. Yeah. We are at historic times with upside. At some point, that has to end. Right. Whether that is in 21, 22, 20, it doesn't really make any difference. But at some point, the cycle will return. It's just inevitable. It's the nature of business. So I don't think anybody, and most of the economists I follow, you can read one versus another. And I think a lot of people that try to say, here's exactly where in the cycle, they have no clue. 5 years ago, they were saying we were done with the cycle. So I just want to get that on the table. But what this provides is in a down cycle. So think about now, we're in the current cycle. You're able to buy buildings, opportunistic. You buy them, you lease them up, you sell them to REITs. In an opportunistic cycle, what happens is people are a little bit like sheep. Not people. I'm talking about investors. And so are companies. And I used to be a big corporate guy. So what happens in a down cycle is you try to reduce your footprints. Yep. You try to different things and therein are tremendous opportunities. Mm-hmm. That's what I meant by in a down cycle, you can find as good a deal or better deal than you can in an up cycle. So what Brian has been able to do in down cycles is find those opportunities in the Western region and to seize on those moments and go in and get very good buys, 30, 35, 40 cents on the dollar, and be able to then lease those up under the market rate, if necessary, or whatever, but lease them up and then sell them back to the REIT. So it's really a perfect storm when it does go south. Yeah. Kind of a different way to look at it as opposed to, oh my gosh, the market's not where we want it to be.
One thing I want to touch on is the idea of where we are in the cycle and this concept of a recession. One of my concerns, first of all, a recession is a natural thing within an economy, right? Yeah. It actually is a good thing. It helps to keep things in balance. You can't go on a trajectory forever because the wheels will come off the bus eventually. Yeah. And one of my concerns is that I think in the American psyche, an investor psyche, that what happened in 2008, 2009 was a recession, and that what we're going to see in the next 12, 24, 36 months is going to be something similar. What happened in 2008, 2009 wasn't a recession. It was a great recession and was an anomaly of 80 years since the Great Depression that we had. And so one of my concerns is that people may overdo it and in their mind and think that we need to go down deeper than we actually need to. If that happens, again, I do believe there's some great buying opportunities, but I think we need to keep in check this idea of a recession, that yes, it may come, but even within a recession, you can still do decent deals. So again, some of my best deals that I ever did were in 2008, 2009, and the same thing with up economies. So just make sure you're always buying for the right reasons, and you stay focused on what you do. All we do at North Star Commercial Partners is buy good value-add real estate and execute on that real estate. We're not investing in companies. We're not doing all this other stuff. We are real estate people successful. What these gentlemen do is worked as a trust and advisory firm, coming together and always focusing on that, I think really separates us.
And sometimes, frankly, we have some very interesting conversations.
We do.
Because of those two lenses. And I think that's really healthy. You know, iron sharpens iron. And if his best and brightest are debating it and looking at things with our best and brightest, you get a better decision.
Yep.
And that's what the algorithm is there for, right?
Absolutely.
I mean, you've honed it over the last 20 years. So it's been, up to this point, it's been successful, and you've made your clients, your investors in the past, quite a bit of money. And, if all goes well, that should continue in this strategy here. So how do clients how do they get access to you? How do they get access to the strategy in this fund? And what are the requirements? What are the minimums? Again, a traditional REIT you have to hold for 7 to 8 years. So let's just talk about some of the specifics of this, and then how they get find out more about this strategy.
Absolutely. Go ahead.
Well, let's start with how they get hold. So we're going to put on the on the tagline here how to get a hold of us. They can get a hold of Brian or myself or any of our staff, and we'll get that on the tagline here that probably will be running on the bottom of what I'm saying right here. So that's first and foremost. I think probably the best thing for people to do is have a conversation. Not look at I'm going to rush in and make an investment, but have a conversation with a financial advisor like yourself, like others. Sit down, go through where they are in their investment portfolio, what they might need. The minimum on this is $50,000. That's very unique.
Very unique. By the way, most places are 100, 250, 500,000. So 50,000 is very attainable for most people.
Right. And you still have qualified investors, and you want to make sure that you're not putting people in a position where they're not comfortable with the investments they're making. So we think that's important. Now the initial lockup on this is 2 years. What that means is for 2 years, you can't, if you put dollars in today, for 2 years, you can't take those dollars out. And the explanation is very simple. That's about the cycle that Brian has in a turn. And what I mean by a turn is you go in, you identify an asset. You decide that is the right asset to purchase. You purchase the asset. You lease it up with a group of Fortune 500 and other companies over about a 12 to 18-month cycle. You make the changes in the building you have to make, and that cycle is about 2 years, historically, if you look at Brian's cycle. So that's the logic behind that. And then at that point, the assets obviously would be sold. The income comes into the fund, and we have distributions.
In addition, in terms of signing up as an investor, so you can go to the North Star Commercial Partners website, which is northstarcp.com or northstarcommercialpartners.com. And in there, there's a portal and access to get documents to the fund as well. We also have a website for the fund directly if one would like to access it. All the investment documents are right there. And so an investor can go online. They can go ahead and fill out their forms. I get an email immediately, add my signature to that, and then they're in the fund. We have monthly closings for the fund, and so as soon as someone commits, that's when the ticker starts on their dollars. And so let's just assume that in the next month somebody decides to make a commitment to the fund. We go ahead and start deploying capital and going from there. When we get ready to make distributions, the distribution is on the date of the closing of the month that they came in on. So there's an incentive for someone to sign up sooner rather than later. We have 4 opportunities right now that we would like to deploy capital in. They require about $50 million of equity. All of them, from our perspective, meet or exceed the pro forma returns that we're projecting in the fund at the investor level. And what I like about it, there are different products in different states. And so again, this fund is going to provide diversification, not only in terms of size, but asset class and location, which I think is a really important part. And so we made that $50,000 number so it would be more approachable to more people. And our hope is that we continue to grow those relationships with them for many years to come.
Well, I guess one other point I would make is that this is what's called an evergreen fund. And let me talk about why that's important and why some people might misunderstand like a closed fund, when's it closed. Evergreen means, to Brian's point, if you put money in today, whenever today is, and an event takes place, that is an evergreen amount of money that we can continue to take and build on. But you're getting a return from the day you put your money in.
Yeah.
That's very important. The target for the initial fund is 125 million, but we can go up to 400 or 500 million very easily. Brian and I both believe that when we look across those western states, the opportunity is pretty immense.
Yeah.
It really is immense.
There's a lot of buildings that you guys,
Lot of-
your algorithm can find,
Yeah.
Absolutely.
flip, and make a return on.
Absolutely.
I mean, you're not you're not looking in just some small little area. I mean, the Western U.S., a lot of great opportunities.
A lot of great opportunities.
Well, and even at North Star, since we founded the company 20 years ago, we did an analysis looking at returns on a historical basis and compared Colorado, which is our own backyard. We've been doing deals for a couple decades and looking to all the investments around the country that we've done. And again, now we're in 15 states. And actually, our returns on average have been higher outside of Colorado than within Colorado.
Really?
Which is interesting because
Yeah.
you would think in your own backyard you would do better. But part of the reason is Colorado hasn't had as many opportunities to the level that we want to execute on.
Yeah.
But we've taken a lot of that experience and deployed it around the country. And so real estate by nature is a localized business, but we've been able to prove over time that if you have the right team in place and the right execution strategy, you can make money in different markets as well and still benefit from that diversification.
A little bit of a contrarian comment from me on that, which Brian and I do a lot. Denver's hot now.
It is.
Let's just be blunt. Salt Lake's hot right now. So,
Yep.
In the West right now, there's just a lot of activity. And what's amazing is I travel, particularly in the East Coast, and talk to some of my colleagues out there. There's a great interest in people investing in the West now. And it really kind of has only emerged in the last 3 to 5 years, where we've kind of been discovered, if you will. And so that's why I think Brian's expertise in these Western states is very, very important.
And let's go back to one of the points. I know we've kind of beat the drum a little bit on the why, as a REIT, why we're different.
Yep.
A lot of REITs that you might invest in, Wall Street REITs, whatever, they focus on one product type, right? It's either multifamily, it's industrial, it's office, whatever. Our particular structure, we're focused on 4 product types. And that is office and industrial properties, medical properties, and senior care. And we have tremendous experience in all 4 categories. And so this fund, Western U.S. focus, so you have diversification, but focused on the West where there's a positive outlook for the future. You now have 4 different kinds of asset classes that we're looking for and having our expertise and platform to be added to it. So we think it's a very powerful combination that separates us again from REITs in terms of, industrial may be doing really well and senior care may be hurting. But if you're in a senior care REIT, guess what? You're going to be going down with the ship, right? And so that's why we have this. We have different cylinders that are always firing so that we can help maintain and grow our returns.
And that's why, from my viewpoint, it's important to be diversified.
Absolutely.
Right? It is extremely important to be diversified. I can't tell you how many times I've seen clients come in with REITs and they are essentially like different named REITs, but when you dig into them, they all own the exact same thing, like
Exactly.
Grocery centers and shopping mall type of things. You're like, you've got $700,000 in 7 different REITs that all own the same thing.
Yeah.
So
well, you bring
Pretty
up
common.
We also bring up another good point. I believe that where we are right now in society, that real estate as we interact with it is going to change tremendously before our eyes. With the advent of new technology, artificial intelligence, the aging baby boomer population, et cetera. So if you're just in one asset class, you don't know what the changes are going to be 3, 5, 10 years out. I mean, look at driverless cars, for instance. Like, how is that going to change society? And so that's why we like that flexibility, specifically in an evergreen structure, to say, you know what, we can see, a year out, and we know the technology is not going to change so much in a year, and so we can invest in X asset and go ahead and execute on it. But if you put all your eggs in one basket, you may drop that basket and all your eggs are going to make a mess on the ground. And so that's why we like that flexibility of that diversification.
Diversification is the key, and especially if you're using partners that know what they're doing, which, again, 20 years of experience, you haven't built a small business by accident. It's been on purpose. You've built a successful business, and teaming up with Integrity, you guys have brought a phenomenal strategy to the market that the average person can execute on and be able to tap into this commercial real estate. Whereas before, if they didn't have $1 million or $2, a couple $1 million, they just couldn't get access to it.
Correct.
So I love what you guys are doing. I think it's fascinating. I think people are going to just absolutely love it as long as they get the information, they read it, and they see how you guys are different, that you're just not a REIT.
Mm-hmm.
You're the stage, right, that sells to REITs.
Mm-hmm.
The opportunistic fund. That's what this is. So again, the website that is launching shortly, what's the website?
I don't have. I can't tell you what the name is because we just got the rights to put it up on.
Okay.
Let's see, what's today? Day before
Thursday.
yesterday.
Okay.
So, but we'll have that up for this webcast. We'll have it up and we'll have it run at the bottom of the ticker here.
At NorthstarCP.com.
Yep. And then my personal email address is Brian, Brian, at NorthstarCP, as in North Star Commercial Partners, but just put NorthstarCP.com. Phone number 303-893-9500. And Robert, do you want to share?
And my personal cell phone, call me.
Yeah.
719-338-5295. 719-338-5295. And I take calls all day long.
Absolutely. So I absolutely stress this is a phenomenal opportunity in my eyes. I see it as a really good diversification to an overall portfolio, not just in the commercial real estate space, but as clients want to diversify away from, traditional stocks and bonds, this is a really good potential diversifier for them. And I urge you folks that are watching and listening to reach out to Brian and Robert and get more information and start chipping away at this phenomenal opportunity for these. You said you've got 5 properties right now that are waiting to deploy capital.
Yeah, 4 properties needing about $50 million of equity. Yeah, and I just want to thank Foxstone Financial and you and your father. You guys do a great job, and I love these video blogs. I think they're fantastic, and they're just a great educational resource for your clientele. So just thank you. Appreciate that.
Absolutely. Well, again, this is the Foxstone Financial Wealth Matters Show. I think if you guys have been paying attention, these guys are absolutely having an impact on your wealth. So please reach out to them. Call us if you have questions. Foxstonefinancial.com is our website. Be more than happy to field questions about this strategy and how to jump in it.
Wonderful.
So thank you guys for coming.
Well, thank you so much.
Thanks for your time.
Appreciate it.
Absolutely. Thanks.
Thank you.